Hello, this is Kevin Prince from BMO Exchange Traded Funds, and welcome back to our weekly webinar series. And for those of you who joined us today, you notice it was a new date today, and we'll be back to our normal time on Fridays at 1 o'clock next week. Before I introduce my guests, let's give you some background here. We're going to spend the next 30 minutes, and our focus on this particular topic this week is more around cover calls and understanding the options around cover calls itself. We're going to provide you some insights to the overall options market, as well as give you some historical context towards the markets itself and options. And we'll finish off with a Q&A section. For those of you who'd like to submit questions for us to be answered next week, no problem whatsoever. You'll be sent a survey at the end of this, and that survey there is it gives you an opportunity to send us questions in for next week. And we appreciate if you do send us questions, because it helps us build better content for everybody and more relevant too. This session will be recorded, and if you want to listen to playback, that playback will be available likely tomorrow. All right, let's get started here. Let me start off with an introduction. Let me start off first and foremost with our disclaimers. And what our disclaimers are frequently highlighting is effectively, we're not trying to provide advice here. We're trying to provide you insights to the overall market across the board. And I'll do an introduction first and foremost. Patrick Sineza, he comes from the Montreal Exchange, options expert, does trainer on options, and he'll talk about options with us today, as well as Mark Reyes, our head of product from BMO Global Asset Management. We'll talk about today about options around the cover calls too. So with that, what I want to do is kind of give you some initial context towards the search for yield, because when you're talking about cover calls or options implementation, what you're really talking about here is the search for yield. And this here is just a broad-based chart and kind of give you some ideas why people are looking for yield. And yield is certainly something what you look at in historical context and maybe a recessionary or end of cycle period. So certainly is something to consider in these markets. But also, if you look at it, longer term trends, what people are searching for yield is certainly we've seen both in the United States market and in the Canadian market over the longer period of time, interest rates have been consistently coming down, really driving individuals to look for other sources of yields in the marketplace. And that's effectively what the cover call is, another source of yield. And we'll spend some time talking about it today. Now, when I talk about cover calls, I like to give you just a little bit of a framework, and I'm going to use my two guests to dive into a little more detail. But the framework I give for everybody around options specifically, because it's a part of a cover call, is if you think about it this way, if you've an analogy, I guess, more than else, if you've ever sold a house, you basically entered an option contract. And bear with me, an option contract in a context of houses, you're going to put some money down to buy that house. And that owner knows that if you don't show up in a month's time to take possession of that house, they get to keep that money down. That is effectively an option contract. What we're doing here with cover calls and cover call strategy, instead of doing that on a property, we're actually doing that on stocks. Mark, anything you want to add around that?
I think that's a great start, Kevin. I think the important thing when you start to look at it in ETF format, of course, is you're getting a diversified exposure by names, by expiry dates, by strike prices. So for anyone that's ever dealt with options on their own, having one certainly gives you a lot of concentration risk. And of course, because timing is so important, only amplifies that. By having a portfolio approach with a diversified set of options inside, suddenly the strategy is much more consistent and measurable. Thanks.
Perfect. Let's talk about the elements for a second. I'm going to use both my guests to kind of dive into the elements here, because when you look at the cover call strategy itself and the option aspect, there's really kind of two key pieces coming together, or two pieces. First of all, around the options aspect and then around the dividend. What I want to do is I want to spend a little bit of time about first the options aspect. So again, that in my case, I mentioned the house analogy, but there's really more to it than that, actually that. And I'm going to use Patrick to go and talk to us a little bit about portfolio volatility and what that really means in looking at options. Second of all, looking at the selection criteria of how to pick an option and what those parts are. So Patrick, maybe you can talk to us a little bit first about portfolio volatility.
Sure. And so just going back to something we talked about over the last two sessions, which is we kind of looked at what are probabilities of, let's say, one of these bond ETFs or something going higher or lower, and at least how the option market is pricing it. So it really comes back down to that we look at the volatility of an underlying security, and the marketplace then assigns a probability of, or at least the implied is probability of what is likely to be a move higher or lower in the security. And so what you want, one wants to think about is that as volatility is changing, so is the option price because the probabilities change. So if you go to the next slide, one of the really interesting parts about what's happening in the market today is the fact that while the markets have declined, the volatility correspondingly has risen. And in this example here, I have a chart here of, I think that this is for Enbridge. And but the point being here is that the implied volatilities went from basically 10% to being almost 100% during the peak of the market crash. Now, what is particularly interesting about that is it means that the income you're earning off of covered call writing has materially increased because the value of the option rises. And so what happens is that during periods when markets are chopping, let's just go with a scenario. Well, one scenario is the stock market may fully recover. The second scenario is maybe the market stays in like a sideways purgatory for the next 6 months or a year and just chops higher and lower and doesn't make any progress. When you have such high volatility, you're able to create income strategies around it with covered call writing that don't need the market to rally for you to make returns. And this is where we're going to talk about how we can use options as a way of diversifying the portfolio by adding strategies into our mix that don't rely on capital appreciation, but will focus on income as one of the ways to create your returns. So if we go to the next slide. So what? Oh, going back to that time premium. There we go. So one of the things that we want to talk about is the selection of an option. And one of the things that I'm sure Mark will even reference when talking about the way that this is done in ETFs is the focus on where on this curve that you're actually selling premium. What it is that if you let on many occasions, a lot of these ETFs will focus on 30-day options or options that are shorter in duration, because what they're looking at is that right-hand side where the rate of the time decay is accelerating for an at-the-money option or even an out-of-the-money option. What it's trying to do is take advantage of this very rapid time decay that is happening to allow you to harvest as much of the income as quickly as possible, while you could do all sorts of longer dated options which have a slower rate of decay but give you a larger guaranteed income or premium up front. There's also this the issue of where you're selling the premium. Do you sell it where it's at the money or out of the money? So what is that the term that I would put? So let's just go stick with your new home sales example of real estate. And so let's just say that a scenario is that you come to a new home sales place and you say, I want to enter a contract that a year from now, when these homes are finished, I'll lock in the purchase of this house for $500,000. So you've locked in a guaranteed $500,000 purchase and you put up a certain amount of premium to lock that in. Now, what happens is if the house, the value of the real estate market, it drops, and let's say it's at 450,000 average market value of those homes, you still have a contract that is giving you a guarantee to buy it at $500,000. So when we use the terminology in options trading of in the money or at the money or out of the money, it's about where the price is relative to where the contract says you have the right to buy it. And so a lot of covered call writers and a lot of the covered call writing strategies that you'll see, they'll focus on selling premium at farther out strike prices or farther out. Now, when later on in the presentation, I'll give an example with Enbridge of selling one of these out of the money options. How did I do at describing that, Kev?
Yeah, I think that's good. I mean, effectively what you're really saying is that, twofold, you're trying to set a price a little bit higher than it's worth today because you want to capture that. You'll capture some of the market upside, but willing to sell the rest of it off. And the second thing you're highlighting here is that, the time, you could really the different time periods have different value itself. It's going to basically move that option in for the person who owns it, the person that sells it to somebody else, that's going to expire worthless. So you get a value of that over a short period of time.
Right.
Hey, Mark, let's talk a little bit about, in this case, percentage written, because in the concept here, you can do, of course, 100% written, but maybe we should talk a little bit about the different implementation examples, and maybe you can give you the 25%, 50%, and take it up to 100.
Sure, thanks, Kevin. So yeah, I think as we start to look at how can you do a covered call strategy or an option writing strategy, so you're, maybe moving on from the house, talking about actual stocks. If you own a stock and you're unsure of what that forward price activity might be, or you're less positive on markets, writing a call to generate more income while you continue to hold makes a lot of sense. So when we do that, you want to make sure that your portfolio or your holdings, that you're still getting an exposure to price appreciation, right? The last thing you want is, the stock to go up, let's say 20%, and you wrote on your entire holding at the money option, so you get whatever that premium is, but you get none of the upside of that price appreciation. So we always caution people, and the way we approach our portfolios is a lighter touch with the option writing. So number one, writing out of the money. That means on the entire position, you get a price appreciation up to whatever that exercise price is. But as well, we write on about half the portfolio or half the position. So regardless, we don't cap out the stock, that exercise price, on half the book. So in that scenario that I gave, that something went up 20%, 50% of that position is going to get that whole 20%. On the other half, it's going to get up to wherever you wrote that option out of the money. So let's say you wrote it 5% out of the money, half your book is going to go up 5, half your book is going to go up 20. So you're still getting the vast majority of that market appreciation. So I think it's really important when you look at option strategies to not be too aggressive on attempting to harvest yield by either writing, aggressively in the money or at the money, or writing on your entire position. That make sense, Kevin?
That makes sense, and I appreciate the examples, because that is all part of the consideration. What do you want to trade off versus the income you're going to get, and you can do 100%, half of it, or some other portion of it across the board. Hey, Mark, the other thing I think you always highlight is how important the underlying dividends are inside these structures, or as part of the equation too, because of course the premium is addition to the underlying income you're going to earn from the dividend of the company, because of course you're still owning that stock and you're going to get the dividend of that stock. So I put up 4 different examples here, a couple of BMO ETFs, some third-party ETFs too, for that matter. Maybe you can walk us through a little bit of dividend and some of the holdings here, just to outline how important that is a part of the equation towards the total yield.
Right. Well, what I always caution people is, when you're doing a covered call strategy, when you're writing options, you're still holding the underlying security. So that's always the starting point, is, do I feel comfortable holding this name, this stock, this portfolio, this ETF? So if it's a dividend strategy that's diversified across the market, you can feel pretty comfortable. If it's Canadian banks, again, you can feel pretty comfortable. If you start to get into more niche or interesting things like writing on gold, things of that nature, you got to be really careful around what the underlying is going to do. First and foremost, if we get in a scenario like we've been in the last month where markets fall, you're going to fall with that, and you're going to get a little bit of protection from the option writing. But by and large, when a market goes down 20+%, you're going to get most of that. So understand the underlying. As well, the second consideration is, what is the dividend yield of that underlying portfolio? So if your goal is to harvest yield and income, you want to start with a good dividend base. Why? Because then there's less pressure on your option writing. So again, if you think about things like BCE, Enbridge, the big Canadian banks, they've all got solid dividend yields on them. So building a portfolio around those means you're going to have a lighter touch on the options. So let's say you're getting, yields have certainly jumped, but let's say you're getting 4% on the portfolio from the dividends. If your goal is to get 6 or 7%, that means you only need another 2, 3, 4% from the option writing. If you start with something with a yield of 1% or 0%, that means all your yield has to come from the option writing, and inevitably you're going to then have to be more aggressive about that. So understanding the underlying portfolio, knowing how diversified it is, knowing the yield of that portfolio is all really important when it comes to looking at a covered call or a right strategy. Don't just get lost on the mechanics of the options. Make sure you focus on the securities as well. Thanks, Kevin.
That's some good insight there. I mean, look at the yields you're seeing on the screen here, and there's some pretty good yields you're seeing across the screen. I think we're really seeing the combination of those two things coming together. That's that option, and specifically the volatility that Patrick was talking about coming together, as you're mentioning, the underlying companies and their dividends across the board to generate those. And you really need to take a look at both sides, the optionality and what we're getting paid on that side, plus the dividend core yield to make your best evaluation of what solutions are out there. Now, you already talked about a bit, Mark, but maybe you can spend a little bit more. How do they work in respective marketplaces, cover calls? And you mentioned a bit about down markets, but maybe you can spend a little bit more time and dive in a bit deeper in that.
Sure, thanks, Kevin. And as mentioned off the last question, you got to start with the underlying holdings. So that's going to be primary driver of your returns. So in a sharply declining or down market, yes, you're going to get some offset from the call premium, but you're going to move down with the markets. Yes, you'll outperform a little bit, but you're going to expose to most of that downside. So down markets, because you're long the stock or you hold the stock, not ideal. Rising markets are okay to a certain degree. Just keep in mind where you're writing against a portfolio. So a reasonable rise in markets is very positive for covered call strategies because you're getting most of that market return and you're getting the call premium. It's when markets really take off and you've sold away what we call that excess upside that you'll underperform the unwritten strategy. So partially rising markets, good. Rapidly rising markets, you're going to see a little bit of underperformance. Sideways markets, that can be interesting as well because, as Patrick mentioned, typically we write short-dated options to best take advantage of the time decay. So depending on the path month by month, you might see something with a flat NAV over the course of a year or a flat price over the course of the year. But if there's been a lot of price movement in the year, at certain times those calls may have been in or out of the money. So really volatile markets can be difficult for covered calls. But at the same time, it also means, of course, that when volatility picks up, there's more premium to be had, which starts to offset that. But by and large, a reasonably sideways market is okay. But again, a highly volatile market, you should expect a bit of underperformance. Thanks, Kevin.
Thanks for that. And then, Patrick, maybe you can walk us actually through a real example here. Now, you've done it up on Enbridge here on a cover call.
Exactly, and so Enbridge, when we go back a few slides, we were looking at Enbridge being one of the top holdings in some of those ETFs because of its large dividend, and so what I wanted to demonstrate is how a retail investor would approach just selling a direct covered call, and obviously, like Mark was referencing, within the mandates of the ETFs, they would, let's say, sell on a portion of it or change the allocation. There's entire strategies around this, but I wanted to make this very blatant, which is we're buying 1,000 shares or own already 1,000 shares of Enbridge, which at the time when I did this yesterday, it was trading at around $40 a share. And so we're talking about an investor, let's say, owning $40,000 of Enbridge. And what we have is a dividend income of $3.24 a year, which is a staggering 8% return at these prices. But what I wanted to highlight was, well, we could enhance the income for the trade-off of some of the upside potential. And so one covered call is sold for every 100 shares. So like Mark was referencing, you could maybe just sell 5 covered calls on half of the position. You can change different things. But in this example, we're just selling an October covered call at 44. So what it is that the stock's at 40, and we enter a contract basically saying we will have all of the upside of our position up to $44, but we're letting a speculator who's buying the call options for the upside to have all the upside above 44. It's a analogy of bird in hand versus two in the bush, which is essentially for forfeiting that, we immediately receive $2.98 premium, which was the mid price of yesterday's price action, which is basically you receive a credit of $2,980 for selling 10 of these calls. That is as real as a dividend. That's credited to your account like cash. And now, while that money is yours to keep, the $2,900, you've entered a contract that you must honor, which is essentially if somebody wanted to have you call their stock, your stock being called away from you at $44 a share, which is a 10% appreciation from where it's currently trading, you have an obligation to deliver. But you have made, let's say in those 6 months, $1.62 in dividends, which by the way has assignment risk because in theory the option could be assigned early, but at the same time you receive $2.98 premium. So in just 6 months, you've made 11.5% income premium off of a covered call right, and still have 10% upside on the stock. And that's the advantage of this high volatility premium. Like Enbridge had only a 10 to 15% vol premium just 3-4 months ago. And so now that the stock market has this much more volatility, that call premium is now paying you that much richer of a premium. And so what I try to get across with this is that in a bear market where there's not a certainty that the market is going to go back to 52-week highs or make new highs within a year, finding strategies to make some income while the stocks are chopping around, you can use strategies like this as income enhancing. And whether you do it through an ETF where they were doing it for you in there, or whether you go directly into the options market and sell covered calls this way, those choices are available to you.
Perfect. And let's take the example now, Mark, with you, with inside an ETF now, because we've got the individual stock. Take a concept and maybe talk about how it works with inside the ETF here.
Sure. Thanks, Kevin. So, we've walked through a direct stock example, and certainly it can be done on your own. I'd just caution there is a lot of work to it because unlike owning a direct security, which of course you simply buy and then at some date way out in the future you think about selling, when you're dealing with option strategies that have expiry dates, you're of course always needing to reset that trade. In other words, you need to sell a new option every 30 days, 60 days, or however you may choose to implement that. So it's a lot of work to do on your own, which is why I very much think of these covered call ETFs, not just as an investment, but as a convenience tool. Why is that? Because all the option writing is being done for you. The contracts are being rolled or reset. The portfolio is being rebalanced as potentially a call expires in the money and you may have to deliver against it. So there's a lot of operational aspects that the ETF just does for you. So within that ETF, it's going to hold a basket of equities. In this example, ZWB, which is a covered call Canadian bank ETF, it holds the 6 banks. Across those 6 banks, we'll write calls directly on the banks. They'll be out of the money. They'll be on about half the portfolio, and they'll be about 30 days to expiry when we write them, again, to take advantage of that time decay. But the really important thing is they're all spread out. So we may have a certain option expiring this week, another one next week, et cetera, going out 4 weeks. That really keeps the portfolio well balanced and diversified in terms of market risk and keeps a consistent level of portfolio yield in the income. What I find most interesting about these strategies is we can be dynamic about the implementation. So as Patrick mentioned, in periods of stress markets, of course, volatility spikes up. Well, what does that mean? That means the call premium that's available at the same strike price inevitably goes up as payment for that risk. So when markets are more risky or higher vol, we can write further out of the money, which gives us more potential upside for that same level of income. And conversely, when markets are pretty benign or quiet, we would write closer to the money in order to generate that same level of premium. So very much we can be dynamic in the approach, target a yield level, and be able to play with the distance out of the money, which is so critical because when markets are highly volatile, you want that opportunity to capture more returns. But overall, where I'd leave you with how the ETF works, think of it as a convenience tool because all that call writing is going on for you within the portfolio. Essentially, all you have to do is buy the ETF just like you would a stock or any other ETF, and then sell it when you see fit down the road. Thanks, Kevin.
Thanks for that, Mark. And just one quick little orientation on the chart there. That blue line you see cascading and now shooting up, that's what Mark was talking about out of the moneyness. So what you're really seeing is the dynamic application of the cover call strategy in the respective markets it's in. And I just wanted to highlight that it's not just BMO ETFs out there. There are a number of different ETFs out there that are in this space. I will note one key thing you pay attention to is what Mark had mentioned before, the percentage written across the board. That's a factor to consider in the different strategies out there. And I'd also highlight exactly what Mark said too. Pay attention to the underlying companies themselves, and that they have a dividend base to them, because that's a key part of the yield that you'll be receiving. And I think Mark talked already about the cover calls and the ease and efficiency. I'm going to quickly move it to Patrick to say, Patrick, let's say people want to find more about individual options. Where would they go for that?
Well, whether you're going for individual options or whether you just want to better understand what these ETFs are doing, we have all sorts of great content at the Montreal Exchange to educate all the listeners just on how options work and strategies such as covered call writing and the dynamics. So whether you're choosing to want to do this independently for yourself or whether you just want to understand what the managers are really doing or what they're saying, like when you hear Mark talking about all of these different strategies, you can educate yourself for free at Montreal Exchange, where there's all sorts of resources. If you go back one slide, actually, Kev, there's all sorts of resources on the m-x.ca/education. You don't even have to do the /education. If you just go to montrealexchange.ca on the drop down, there's the education, and you click it. You're going to get everything from a covered call screener, a covered call calculator. You're going to get a strategy guide and all sorts of webinars on how to educate you on this stuff that we were talking about today.
Perfect. And we got a few more minutes left for questions, so let me bring a few questions up. The first one I have for you there, Patrick, is really all about volume, right? So let's say people want to enter cover call strategies. Where would they, and the volume may not be there. Give us some insights around that.
Well, volume is how much is traded today, and open interest is how much contracts are open at those particular strikes. But the one thing that I always like to point out to everybody is that the volume and open interest is not necessarily reflective of the liquidity, because market makers are there to provide the liquidity. And often just because there wasn't a lot of interest at that level, so let's just give an example. If, let's say, one of the bank stocks was trading at $100 and subsequently has like we experienced in the last month, had a rapid decline down to 80, that is not a pleasant experience. But if you're looking at all the strike prices down at 80, 82, 84, 86, there's not going to be a lot of volume and not a lot of open interest there, because the stock just hasn't been trading down at those strike prices for any extended period of time. It doesn't mean that there isn't a liquid market available to you. It just means that the stock just hasn't traded there long enough for there to be enough traders to have started to build big positions around those levels where the price is trading. And so I always say that's a little deceptive. The more a stock is trade range bound, the more you're going to have open interest and volume at the money strikes, and the more volatile it is, the more you might find yourself in levels where there doesn't appear to be a market, but the market makers are providing plenty of liquidity there.
Well, thanks for the insight there. And I think we have a question, one more. I was just quickly highlight to Mark because it's related. I'm going to skip right to it here. Bear with me. Mark, there is occasions where things hold, one ETF may hold another ETF inside there. Does that mean double dipping of fees, or how does that work?
Sure, thanks, Kevin. No, there would be no double counting of fees, and that's consistent across the street. If an investment product, an ETF or anything else holds another one, they would take that into account when determining the expenses of that fund. So as a real simple example, if a fund that charges 1% holds something that charges 1%, and that's something that's half the weight of the portfolio, it would only charge that additional 50 points. So it'll only end up being the fee of the top fund. There's no double counting of the fees.
I think it's an important thing to highlight. There's no double dipping. The fee they're being charged is the fee inclusive of the underlying holdings. Now, I apologize. We have a chance to go through many more questions today. We'll spend a little bit more time on questions next week. We're going to talk a bit next week about options, but also in this case around currencies too. So we're going to spend some time on that next week. I do appreciate everybody taking the time to join us today. Please send in your questions because it only makes these programs better and more related towards yourself. Thank you very much for joining us today. Thank you very much for my guests. See you next week on Friday now, back at 1 o'clock. Cheers.